Welcome to the program You Can Beat the Stock Market. Here we show you how you can beat the stock market, even though you're not a pro like Warren Buffett. I am Francisco, and today I'm going to bust 5 common stock market myths. Can you really time the stock market? First off, let's explain what time the market means. It's the idea that you can buy stocks or other assets right before they go up and sell them right before they go down all the time. It sounds pretty cool, right? If you could do this, you'd be rich in no time. But here's the thing. The stock market and most other markets are super unpredictable. Think about it like trying to guess the weather without any tools. One day it's sunny, the next it's rainy. The stock market behaves similarly. Sometimes it goes up because of good news. Other times it goes down for no clear reason. And you might think, hey, aren't there smart people out there who can't predict these things? Well, even the experts, folks, with fancy degrees and years of experience, can't consistently time the market. Sure, they might get lucky now and then, but over the long term, most of them don't beat the average. Let's say you try to time the market and you get it wrong. That can be cost if you're out of the market on the best days. You can miss out on big gains. And if you're in the market on the worst days, you can lose out. Here's the secret. Most successful investors don't try to time the market. Instead, they invest for the long term. They pick up good stocks for funds, invest their money, and then wait. Over the long run, markets tend to go up, even if they have some ups and downs along the way. Trying to time the market is stressful. It can be a roller coaster of 1 minute you're happy because you made a good move. The next, you're sad because you missed out. This stress can lead to bad decisions like selling when you're scared or buying when you're greedy. One of the biggest pitfalls for individual investors is letting emotions drive decisions. When the market is rising, there's a fear of missing out, which can lead to buy high. When the market is crashing, panic sets in, leading to selling low. Both of these decisions go against the fundamental principle of buying low and selling high. Rather than stressing about market timing, focus on factors you can control. This includes things like saving consistently, investing regularly, reducing debt, and living within the world of investing is vast and always evolving. Instead of chasing the latest trend or hot tip, invest in your financial education. Understand the basics, learn about different investment strategies, and grow with the market. Lastly, remember that wealth usually isn't built overnight unless you win the lottery. It's the result of consistent, informed, and patient decisions over many years. So, while the idea of timing the market sounds tempting, in reality, it's a big lie trying to catch a butterfly with a net full of holes. It's better to focus on the big picture, invest wisely, and be patient. Time in the market beats trying to time. The second myth to be busted is the one that tells the stock market always goes up in the long run. What does long run mean? When people say the long run, what are they talking about? 5 years? 10 years? 50? The idea is that if you wait long enough, you always see a profit. But long enough can be a really, really long time for some markets. Just because stock markets have generally gone up in the past doesn't mean they'll keep doing so. Past performance can't predict future results. It's like saying, it rained last Tuesday, so it would rain next Tuesday too. But we all know the weather doesn't work that way. While big stock markets like those in the US have trended upwards historically, not every country's market has the same story. Some markets have had long periods of stagnation or even decline. Not all stock markets around the world have shown consistent growth like the US market. Here are a few examples of markets that have experienced long periods of stagnation or decline. Japan's Nikkei 225, perhaps the most cited example in Japan. In late 1989, the Nikkei 225 index reached a peak close to 40,000 points. This was followed by a prolonged bear market and a period of stagnation that lasted for decades. Even today, the Nikkei has not surpassed its 1980, though it has shown signs of recovery and growth in recent years. The Greek's Athens Stock Exchange lost a significant portion of its value over the subsequent years, and while there have been periods of recovery, it has been a tumultuous journey for Greek equities. Russia's Moscow exchange. Political tensions, economic sanctions, and other factors have led to periods of decline or stagnation in the Russian stock exchange. While there have been phases of growth, geopolitical uncertainties often play a role in its performance. China's Shanghai Composite. While China's economy has grown remarkably over the past few decades, its stock market has seen periods of volatility and stagnation. For example, after a stock market burst in 2015, it took years for the Shanghai Composite to recover. Venezuela's Caracas Stock Exchange. Due to political instability, hyperinflation, and a series of economic crises, the Venezuelan stock market, when adjusted for inflation, has seen its real value erode dramatically over time. Zimbabwe Stock Exchange. Zimbabwe went through a period of hyperinflation in the 2000s, which heavily impacted the real value of equities on its stock exchange. While nominal values might have seemed high when adjusted for the extreme inflation, the real value was much. It's important to note that while these markets have experienced periods of stagnation or decline, many factors contribute to these trends. These can include economic policies, global economic conditions, political stability, and more. Each market's history and challenges are unique. You should also remember that economies face problems, recessions, wars, natural disasters, pandemics, and more. These events can cause markets to drop, sometimes for long periods. While they might recover, it's not a guarantee. Also, the inflation eats profits. Let's say the stock market goes up 2% a year. But if inflation, the rate at which money loses value, is 3%, you've actually lost money in real terms. So even if the market's price isn't rising, investors might still get returns from dividends. But again, there's no promise companies will always give dividends. While it's true that patience can often help in investing, the idea that waiting it out will always lead to gains is oversimplified. It's always important to stay informed and adjust strategies based on current situations. So, while history has shown some stock market rising over long periods, it's not a set rule. Like a road trip, there might be long stretches of smooth driving, but you'll also hit bumps, detours, and maybe even a few roadblocks. The key is to stay informed, be prepared, and never assume the journey is always on an uphill path. All right, let's dive into the myth. Technical analysis guarantees profitable trades. What's technical analysis? First up, what even is technical analysis? It's like reading tea leaves, but for the stock market. People use charts, patterns, and fancy lines to try and guess where stock prices might go next. It sounds scientific and fancy, right? Well, let's dig deeper. The first thing to know, nothing, and I mean nothing, can guarantee you always make money in the stock. It's a bit like predicting tomorrow's weather by looking at today's clouds. You might get it right sometimes, but not always. Technical analysts love spotting patterns in charts. Things like head and shoulders or double tops. They believe these patterns can hint at future price moves. But here's the catch. Just because a pattern happened before doesn't mean it'll happen the same way again. The market has a mind of its own. Stock prices move for many reasons. News, company earnings, global events, and importantly, people's feelings. If folks are scared or too excited, they might buy or sell stocks in ways that no chart could predict. There's not just one way to do technical analysis. Two people can look at the same chart and come up with totally different predictions. It's not a one-size-fits-all method. If you only use technical analysis and ignore everything else, like if a company is actually going well or if there's a big global event, you might end up missing important info that could affect the stock prices. Big idea in technical analysis is that what happened in the past can tell us about the future. But the stock market has a funny way of surprising everyone. Just because a stock did something yesterday doesn't mean it'll do the same thing tomorrow. There are lots of tools and software for technical analysis. They're flashy and can make cool predictions. But remember, these tools are made by humans, and humans aren't perfect. You might hear stories of people making loads of money using technical analysis. But for every success story, there's someone else who lost money. People usually don't brag about their loss, so we don't hear those stories as much. While technical analysis and its patterns, like head and shoulders, triangles, and others, are widely used as tools to predict future price movements, they are by no means foolproof. Here follows two examples. Head and shoulders. This is a pattern that technical analysts believe can signal a reversal in price. A classical head and shoulders pattern shows three peaks, with the middle one, the head, being the highest and the two on the sides, the shoulders, being lower. But here have an example showing you could find a stock chart that formed a clear head and shoulders pattern during a bullish trend. But instead of reversing to a bearish trend as expected, the stock continued to rise. There are countless instances where, after forming a perfect head and shoulders pattern, instead of a reversal, the market continued its previous trend. Triangle patterns. These patterns, which include ascending, descending, and symmetrical triangles, signal that a breakout is imminent. The ascending pattern should predict the continuation of a high movement. However, the direction of the breakout, up or down, is not always predictable based solely on the triangle. Here we have an example of an ascending triangle that should break up but instead break it down. There are numerous cases where an ascending triangle, typically seen as a bullish sign, led to a downward breakout instead. While technical analysis can be useful, it's important to keep learning and adapting. The market changes, and what worked today might not work tomorrow. It's always good to combine it with other info and strategies. So while technical analysis is like a cool magic trick for the stock market, it's not a guaranteed ticket to profit down. It's one tool in a big toolbox. Always do your homework, stay informed, and never put all your trust in fancy charts and patterns. Let's tackle the myth. Following the crowd leads to better investment decisions. Follow the leader. So there's this idea that if everyone is doing something, it must be right. Kind of like when kids play follow the leader. In the investment world, this is often called the herd mentality. But here's the thing, just because everyone is jumping on a trend, it doesn't always mean it's a good idea. The history of the financial markets is filled with examples of follow the leader behaviors, leading to substantial losses. Here are three notable examples. The dot-com bubble, late 1990s, 2000. What happened? During the late 1990s, there was immense excitement around internet companies. The promise of the digital age led investors to pour money into any company with a .com in its name. Stock prices of these tech startups skyrocketed, with many of them having little to no profit. Follow the leader. Seeing the initial success of some tech companies, more and more investors jumped on the bandwagon, driving stock prices even higher. There was a general belief that the old rules of investing didn't apply to these new age tech companies. The fallout. By 2000, reality began to set in. Many of these companies failed to turn a profit and couldn't sustain their business models. The bubble burst, leading to a massive sell-off. Investors who had followed the crowd and invested at the height of the bubble suffered significantly. Companies that were once valued in the billions went bankrupt, and the Nasdaq Composite, which was heavily weighted towards tech stocks, crashed from over 5,000 points to below 1,500 by 2002. The US housing bubble, mid 2000s. What happened? Leading up to 2008, there was a surge in housing prices in the US. Cheap credit and aggressive lending practices made it easier for people to buy homes even if they couldn't afford them. Follow the leader. Seeing the steady appreciation in home values, many individuals, banks, and hedge funds jumped into the housing market, treating homes as investments that could only go up in value. The thinking was, if everyone's buying houses and making money, why shouldn't they fall? The bubble burst in 2007-2008. The value of homes plummeted, leaving many homeowners underwater, owing more on their mortgages than their homes were worth. The crisis led to a domino effect, resulting in the global financial crisis of 2008. Many who had followed the trend and invested heavily in real estate suffered severe financial losses. Tulip mania, 1630s, Netherlands. What happened? One of the earliest examples of speculative bubble, tulip mania, saw the prices of tulip bulbs in the Dutch Republic rise to extraordinary levels. Follow the leader. As prices began to rise, more and more people started buying tulip bulbs, hoping to resell them at higher prices. Stories of neighbors or friends becoming rich by trading tulip bulbs added fuel to the fire. The fallout. By 1637, prices began to collapse rapidly, leaving many holding bulbs that were worth only a fraction of what they had paid. Fortunes were lost, and the Dutch economy was severely impacted. In all these examples, a common thread is the belief that this time is different. In a herd mentality where people are more influenced by the actions of others than by their own analysis or judgment. Ever blown bubbles as a kid? They grow and grow until pop. The same thing can happen with investments. When everyone starts buying something because they think it's the next big thing, the price goes up and up. But then sometimes that bubble pops and the price drops. If you followed the crowd, you might be left with something that's worth a lot less than you paid, missing the boat. By the time you hear about a hot investment, it might already be too late. If you're just following the crowd, you might be getting in when the smart money is already getting out. Missing out on significant investment opportunities, often termed as missing the boat, can mean missing out on potential profits. But the fear of missing out can also lead investors to make hasty decisions that result in substantial losses. Here are 3: Bitcoin cryptocurrency frenzy, especially Bitcoin in 2017. Bitcoin, along with other cryptocurrencies, saw explosive growth in 2017. By December, Bitcoin reached an all-time high for that period of nearly $20,000. Many investors watching the rapid rise of Bitcoin and hearing stories of early adopters becoming crypto millionaires felt they had missed out on the initial gains. This FOMO led many to buy in at or near the peak. Shortly after its peak, Bitcoin's value started to decline sharply, and by early 2018, it had dropped to around $6,000. Many latecomers who had invested at the height of the frenzy faced heavy loss. Initial pub offerings, the dot-com era, and the late 1990s and early 2000s Many tech companies went public with much fanfare. Their IPOs often saw substantial initial price jumps on the first day of trade. Investors, seeing the initial success of some of these IPOs, believed they were missing out on easy profits. This led to hasty investments in subsequent tech IPOs without proper due diligence. Many of these companies lack sustainable business models and revenue. When the dot-com bubble burst, several of these recently public companies saw their stock values plummet, with some even going back. Late investors, driven by FOMO, faced significant losses. Silver Thursday, 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the global silver market in the late 1970s. Their heavy buying drove up silver prices. Observing the sharp rise in silver prices, many individual investors believed that they had missed out on the early gains and decided to invest in silver, thinking the upward trajectory would continue. Regulatory changes and margin call pressures led to a massive sell-off in silver in 1980. On what became known as Silver Thursday, prices crashed, dropping the value of silver from $50 an ounce to below $11. Many investors who had entered the market late faced substantial losses. In all these scenarios, the fear of missing the boat and not getting in on a perceived golden opportunity. In all these scenarios, the fear of missing the boat and not getting in on a perceived golden opportunity led investors to make decisions without thorough research or understanding of the risks, resulting in significant financial. Imagine being in a room where everyone agrees with each other. Sounds peaceful, right? But when it comes to investing, this can be dangerous. If no one is questioning decisions or thinking differently, big mistakes can happen. If everyone is buying the same thing, it can become overpriced. And if everyone is selling, prices can crash. This can make the market super unpredictable and risky. Following the crowd often means being swayed by emotions. Fear and greed can take over, leading to rash decisions. Smart investing usually means staying calm and thinking things what works for one person might not work for another. Everyone has different financial goals and situations. Just because your friend or neighbor is investing something doesn't mean it's right for you. If you're just following what everyone else is doing, you might not be doing your own research. Understanding an investment, its risks, and potential rewards is super important. Don't just take someone else's word for it. History has shown that following the crowd can lead to big messes. Remember the dot-com bubble? Lots of people lost money because they followed the crowd without understanding what they were really investing in. Sometimes it's good to trust your instincts. If something doesn't feel right, it's okay to step back, even if everyone else is diving in. So, while it might seem like a good idea to go with the flow and follow the crowd, in the world of investing, it's not always the best plan. It's like blindly following a bunch of people without knowing where they're going. You might end up lost or, even worse, stuck in a place you don't want to be. Always do your own thing for yourself and make decisions that are right for you. All right, let's dive into the myth that you can predict the stock prices using historical patterns. Imagine you're trying to drive a car only using the rear view mirror. Sounds crazy, right? That's a bit like trying to predict where a stock will go just by looking at where it's been. History can give us clues, but it's not a crystal ball. Stock prices can go up or down for a million reasons. Company news, world events, or even just because a stock did something in the past when a certain thing happened doesn't mean it will do the same thing again when something similar happens. The world today isn't the same as it was 10 or even 5 years ago. New technologies emerge, political landscapes shift, and even the weather can be unpredictable. All of these can affect stock prices. So even if a pattern worked before, it might not work now. If there was a simple pattern that always told us what a stock would do next, don't you think everyone will use it? And if everyone's doing the same thing, the pattern might just follow. Stock markets are a bit like big, wild parties. Sometimes they're happy, sometimes they're sad, and often they're just plain unpredictable. People get scared or excited, and these emotions can mess with those historical patterns. Imagine you're trying to finish a jigsaw puzzle, but you're missing half the pieces. That's kind of what it's like using just historical patterns to predict stocks. There's so much information out there, one piece isn't enough. Even big experts, with all their fancy tools and years of experience, can't always predict where stocks are headed. If they can't do it with all their resources, it's a sign that predicting stock moves isn't straightforward. Markets learn and adapt. What worked as a strategy a few years ago might not work today because traders and computers have caught on and adjusted. It's essential to look at the big picture, gather as much information as possible, and be prepared for surprises. Because just like life, stocks can be full of the. Hey folks, thank you so much for watching this video. I hope you found it helpful and learned something new about stock market investing. If you enjoyed it, please give it a thumbs up and share it with your friends. That really helps us out. Subscribe. Don't forget to hit that subscribe button and turn on the notification bell so you never miss out on any of our future videos. We have a lot of exciting content coming up that you won't want to miss. If you have any questions or want to share your thoughts about investing, please leave a comment below. We love hearing from you. Remember, investing is a journey, and we are here to help you every step of the way. Happy investing, and we'll see you in the next.